Now, let's analyze the long put position. When we expect a decline in the stock price, profits can be maximized by purchasing a put option. According to technical analysis, we will get a bearish signal when the stock meets the following criteria: stock price at resistance level or at upper channel line, decline in volume, and RSI near or above 70%. Let's consider the following example. On February 14, 2011, the Amazon company gave us a clear bearish signal because the stock touched resistance, and this was accompanied by a decline in volume and an RSI above 70%. As we said, on Monday, February 14, 2011, Amazon gave us a clear bearish signal. Suppose at that time we had decided to buy put options in order to maximize profits of this decline in the stock price. At the close of that day, Amazon was trading at about $191, so we had bought 2 put option contracts with a strike price of $190 and expiration in March 2011. That is, we had bought 2 Amazon March 2011 strike price $190 puts. The February options expired on Friday of that week, so it did not make sense to buy them. The premium of each contract was $6.5, so a single contract had a cost of $650. Remember that an option contract represents 100 shares. Thus, the 2 contracts would have cost us $1,300. With the 2 contracts, we would be in control of 200 shares. It is important to note that the puts are out of the money. This is because the strike price of the puts is lower than the stock price. A few days later, the stock started to fall until it reached the price of $169 on March 1, touching the 1-month support. That can be seen here. We buy the puts on February 14, the day we got the bearish signal, and a few days later, the stock started to fall until it reached the price of $169 on March 1, touching the 1-month support. At that time, the premium of the contracts was a little more than $21, so the 2 contracts would be worth approximately $4,200. If we had sold them at that time, we would have made a profit of $14.5 per share. Thus, we would have had a total profit of $2,900, making a 223% return on investment. That is, a gain of 2.23 times the money invested in only 15 days. On the other hand, if we had shorted 200 shares of Amazon at the initial price of $191 instead of having bought the 2 puts, we would have invested $38,200. With options, we only invested $1,300. If we had bought the shares at $169, we would have made a profit of $22 per share. We sold at $191 and we bought at $169. That is, we would have made a total profit of $4,400, making an 11.5% return on investment. With options, in contrast, we had a return of 223%. Clearly, here we can see the leverage effect of investing in options. After March 1, the stock price rose for 2 days, but then fell to a low of $161 on March 15, 3 days before the option's expiration. At that time, the stock established a new 3-month support. That can be seen here. After March 1, the stock price rose for 2 days, but then fell again to a low of $161 on March 15, establishing a new 3-month support. At that time, the premium of the contracts was about $29, so the two contracts would be worth approximately $5,800. If we had sold them at that time, we would have made a profit of $22.5 per share. Thus, we would have had a total profit of $4,500, making a 346% return on investment. That is, a gain of 3.46 times the money invested in only 29 days. On the other hand, if we had shorted 200 shares of Amazon at the initial price of $191 instead of having bought the two puts, we would have invested $38,200. With options, we only invested $1,300. If we had bought the shares at $161, we would have made a profit of $30 per share. We sold at $191 and we bought at $161. That is, we would have made a total profit of $6,000, making a 16% return on investment. With options, in contrast, we had a return of 346%. Again, here we can see the leverage effect of investing in options. Well, now let's analyze the risk graph for the long put position. Again, what we can see here is a graph with two axes. On the vertical axis, they are indicated the profits or losses of the position, and on the horizontal axis, it is indicated the stock price. It is important to mention that the graph indicates the profits and losses of the position at expiration, and besides, the values do not include brokerage commissions. So, what are plotted on the graph are the profits and losses of the position in relation to the stock price at option expiration. In this case, of course, it is a put. The maximum profit we can make when buying a put option is limited, and this occurs only when the stock price falls to zero. On the other hand, the maximum loss that we are exposed to when buying a put option is also limited because the most we can lose is the entire premium paid for the option. That occurs when the stock price at option expiration is higher than the strike price of the option. That is, the maximum loss occurs when the option expires out of the money. At option expiration, in the case of being in a profitable position, the profit is calculated as the strike price of the option minus the stock price minus the premium paid. A very important value of the graph is the one known as break-even point. For the long put position, the break-even point is calculated as the strike price of the option minus the premium paid. The break-even point is very important because it represents the stock price at which we move from a losing to a profitable situation, or vice versa. In our case, for stock prices lower than the break-even point, we are in a profitable situation. The profit is calculated as the strike price of the option minus the stock price minus the premium paid. In contrast, for stock prices higher than the break-even point, we are in a losing situation. In the case that the stock price is higher than the strike price of the option, the loss of the position is maximum and is equal to the entire premium paid. Here's a comparison between the long call and the long put positions. In the long call position, we are bullish on the stock. What we do is to buy call options in order to sell them at a higher price. That is, we buy and then sell. In contrast, in the long put position, we are bearish on the stock. What we do is to buy put options in order to sell them at a higher price. We buy and then sell. In the long call position, the profit is unlimited. This is because the increase in the stock price has no limit. And if the stock price increases indefinitely, the premium of the call option will increase too. In contrast, in the long put position, the profit is limited. The maximum profit occurs when the stock price reaches zero. In terms of loss, both for the long call position and for the long put position, it is limited. The most we can lose is the entire premium paid for the options. Well, what is the risk of investing in options? The main risk of trading options comes from time, which is limited. If we buy stocks, and momentarily our prediction is going against us, we could eventually wait as long as necessary for a turnaround. In contrast, with options, we cannot wait indefinitely because they have an expiration date. Let's consider the following example. Suppose Apple is trading at $406 and gives us a clear bullish signal. We decide to buy one call with a strike price of $410 and 25 days until expiration. The premium of the contract is $10, so the total cost is $1,000. We control 100 shares. If the prediction is going against us, and on expiration Friday, the stock price falls to $375, we will be losing the $1,000 of the premium because the option will expire worthless. That is, it will expire out of the money. On the other hand, an investor who has purchased 100 shares of Apple at $406, that is, an investment of $40,600, will be losing $3,100. In this case, the investor can hold the shares until Apple returns to $406 in order to recover his loss, because the stocks never expire. In contrast, with the call, we will never recover the loss because the option will finally have expired.